House Democrats are looking for ways to pay for new jobs, creating legislation. Speaker Nancy Pelosi says a financial transaction tax enacted globally could actually be the way to do it. So is she right? We want to ask Ann Lee, adjunct professor of economics and global affairs at NYU, and Phil Kerpen, policy director at Americans for Prosperity. Great to see you guys.
Thank you for having me.
Okay, Phil, I'm kicking it off with you. What would be the ultimate consequence of a tax like this, a financial tax that's layered on transactions internationally?
Well, I think it's interesting that Speaker Pelosi recognized that doing this in the United States would be a disaster because we would just send all the business overseas. That's why she wants to do it on a global basis. I think that is equally a disaster to pursue on a global basis. This will destroy returns for a lot of investors. This will send people out of financial markets. It will raise the cost of capital. It will be a dramatic drag on our ability to have as little friction as possible and have an efficient allocation of resources. So I think this is a big, big mistake. And I also think the idea of finding a huge new pot of money for more stimulus spending is a mistake because the stimulus approach that we've been trying of just pushing money out the door for infrastructure and so on is failing.
And why would we want to discourage investment at a time when we're trying to get the economy back on its feet?
Exactly.
I completely disagree. I think that it's a great step in the right direction because I think we can all agree that short-term speculation is not going to help the global economy grow. And what we need to do in order to discourage that is to put the right incentives and the structure in place. A tax on short-term financial transactions would actually be one of those ways to encourage long-term investing as opposed to short-term investing.
But isn't this what the market is about?
Actually, that's a myth. The buy-and-hold investors would be whacked perhaps as hard as anyone, perhaps harder than anyone else on this. You look at low-cost index funds like the Vanguard S&P 500, the way they keep that expense ratio low is that they have very low transaction costs on their trades. If you put a transaction tax in, there is no such thing as a low-cost index fund anymore because every trade that they've got to have to match the index is going to be taxed. And so I think that the long-term investors, the mutual fund investors, get whacked very hard by this. In fact, you could perversely create an incentive to do more trading because you need strategies that can overcome that tax on every transaction. So I think that that is unlikely to be the effect of this. And I'm also very concerned just about all the money that you're taking out of the financial system in general with this and giving to government.
I completely disagree with that. If you want to play in this game, then you should be paying to play in it. What everyone is criticizing about this whole credit crisis is that the taxpayers that were not involved with these financial transactions were left footing the bill.
But Ann, don't you eventually pay? I mean, if you actually make a profit, you're going to pay taxes on that profit. If you lose money, well, you've lost money. So isn't there some stake that everyone has in this marketplace?
100 million people own stocks. They're all going to be affected. 100 million Americans. Main Street, Wall Street, North, South. They're all going to be affected by this, Ann. And if it's such a good idea, why is Tim Geithner and the Obama administration against it?
They're against it because, quite frankly, the banking lobbies are against it. It's obviously going to impact their profitability. But I think that if people were doing the right things in terms of long-term investing, they're going to earn a profit anyway. And so people who own the stocks and bonds, if there is a good reason to own them, then they're going to earn a profit despite having a small tax on it.
Isn't the capital gains tax enough? I mean, we're already seeing it go from 15 to 20 in 2011, probably up to 25.4 if something like the House health care bill passes. To me, that's more than enough tax to penalize people who have profits in their investments. We don't need a transaction tax on top of that, especially one that'll hit people who are making losing trades. You're taxing people who might not even have profits. So I don't agree that we need more taxes on stock transactions.
Financial services were over 20% of the S&P profits. I really think that there's plenty of profit to go around. We already agree that the financial services is just overrun by folks who are playing in this game. And I think that what you need to do is restructure the system so that you have people who are investing in the long term and then getting rid of a lot of people who are doing short-term trading, arbitrage, and having more people going to more productive activities.
Okay, we're gonna leave it there on that note. Viewers can think about this and weigh in themselves. Coming up next. Thanks so much, guys. We appreciate it, Phil and Ann.